Hello and welcome to the second episode of Hardman Co's Private Valuation Forum, where we delve into the world of valuations and market trends and talk to leading participants in the market. I'm Richard Angus, I'm Head of Business Development at Hardman Co, and it's very good that you could join us today. So we are going to be focusing on two aspects this morning. We're going to be taking a quick look back at what's been happening in 2024, and then we're going to be looking at what might be happening in 2025. And there are a number of factors in the market that suggest we are at an inflection point. But of course, sentiment is only one thing, and the actual factual basis of many transactions, which Doug will be referring to in a minute, is the other element. So it's been a challenging year in 2024 for private markets. I think we all know that. One of the problems has been that the mechanism by which money gets transferred between companies and investors and companies has basically slowed down. So less exits, less money gets transferred into new opportunities. Fundraising in the EIS world, for example, has been particularly tough. And what this means is that although investors are sitting on the sidelines looking for opportunities, which in a more buoyant economy, they will probably be taking immediately, entrepreneurial spirit and endeavor is still very strong. What needs to happen is we need to basically re-engineer the momentum in the sector. So it's not all doom and gloom. I mean, we've had the emergence of new opportunities, and AI has made a major impact on a lot of businesses. And I think the reality is it will continue to do so. So this isn't all doom and gloom. The other thing that we've been looking at is the number of companies that have essentially been delisting from stock markets, and they therefore become private companies. They have maybe less contact with shareholders, but the point about it is that they still need to survive. They probably still need funding, and there's a whole new generation, if you like, of platforms and other people involved in trying to make sure this happens. So I think in 2025, we will see quite a few developments in that space. And part of that is how do you raise liquidity for companies, for shareholders in this sort of environment. And that's going to be the topic probably of our next speech in the middle of January 2025. So I think at that point, what I'm going to do is hand over to Doug, and Doug's going to give us an update on what is actually happening in the market. Doug, you do a quarterly review. I think this is a very timely update. So I'm going to hand over to you. So this is Doug Lawson. He's the CEO and founder of MarktoMarket. Thank you, Doug.
Great. Well, good morning. And thank you again to Hardman and Richard and Alona for having me. And very nice to be here with Peter as well, who's been a very supportive customer and friend of MarktoMarket, as have Hardman. And what I'd like to talk about today is just some of the trends in the market. So Peter is obviously a practitioner, and we'll be seeing what's going on the ground. And I'm going to talk a bit about the data. In terms of MarktoMarket and what we do, we were founded, I co-founded the business in 2017. And what we wanted to be was a sort of a Bloomberg for SME private company data. So for anybody involved in investing or advising in the SME markets, we wanted to be the go-to data provider. We are venture capital backed by 3 institutions, and we're based in Edinburgh. And we currently have about 33 people, and we have our customer base is hundreds of corporate advisors, accountants, private equity firms, lawyers, wealth managers, anybody that's interested in understanding data in the SME markets. And those customers are using us to do a variety of tasks, but a key one is valuation, is understanding what the market is, how the market is trending in terms of deal values and deal multiples. So I just want to talk about, we can look at valuation, or we look at valuation through 2 lenses. The first one is M&A activity. So it's obviously a great guide to what a business is worth, what multiples have been paid for a company, companies in different sectors recently. And then we also look at fundraising. So companies that raise capital, what valuation have they been raising money at? And just before I dive into that, I'll just talk a bit about deal activity, because it is the deal activity that gives us the data that we can give to our customers. So if we just look at the UK, This chart shows the this is monthly UK M&A activity. So our definition here is a change of control situation in a company where one of the parties involved in the deal is UK based. So it could be cross-border transactions, but this is only data where one of the parties, at least one of the parties, is from the UK. This covers approximately a 5-year period. I think that if you look at this chart, what you would typically see is about 400 deals happening per month. But we've had a lot of volatility over the last few years. That volatility has been in 2020 when deal volumes were very depressed because of lockdown. And then we had this incredible acceleration in terms of deals in 2021 when the market became extremely buoyant. 2022 was pretty active as well. And then as 2022 continued, volumes started to reduce, and that continued into 23 and kind of stabilized again in 2024. We've just witnessed an incredible month in October, which was M&A activity that was completed with the budget as a deadline. So people that wanted to get deals through before any changes were implemented in capital gains tax. So if you typically see 400 deals happening per month in the UK, that number actually is now already over 700, and I expect it to probably get 750 to 800. So we had effectively double the number of transactions in October of this year. This is annual volumes this time. So just to look at, how we're trending on an annual basis, I think this chart probably does a better job of that. If you look at activity relative to 2021 and 2022, and Richard kind of alluded to this earlier, activity is subdued. But actually, it's still reasonably good relative to pre-2021. I would say 2020 was an odd year, was an outlier year as well. But if you go back to 2019, 2018, activity levels are reasonably healthy now. Again, 2024 will be over 5,000 because of that boost, the budget boost that we had in October. This time, this is fundraising activity that we're looking at now. So this is the number of equity fundraising, so new money being invested into UK companies. This is looking back the last 3 or 4 years. Again, we had a bit of a bonanza in 2021 in terms of capital raisings. That started to taper off in 2022. A bit of a correlation between interest rates starting to rise and the amount of capital and the number of events that were happening. You can see what looks like a very dramatic tailing off in the third quarter of this year, so at the end of the chart. I wouldn't be too concerned about that. A lot of this data, there's a lag on a lot of this data. So I would expect that to pick up. And actually, if you kind of normalize that or make an adjustment for that, it would come up to about 500 per month. So about, in a typical month, just to put everything into context, typically UK M&A, 400 to 500 deals, equity fundraising is probably 500 to 600 deals is what we would expect to see. This again just looks at it rather than monthly on an annual basis. So you can see that in 2021, 2022, we had these very, very positive years for equity fundraisings into private UK companies, tapered off in 23 and has sort of stabilized in 24. So now looking at valuations. So what we do is we collect data on M&A transactions that happen, and then we try to pull together the deal values, the enterprise values, and then we try to pull together the fundamentals of the business that has been bought, the revenue and the adjusted EBITDA. And what we do is, as well as allowing our customers to search across the platform for deals that are relative to the exercise that they're doing. For example, valuing a business that's in the precision engineering sector, you would look on MarktoMarket for precision engineering deals that have happened recently and look at the multiples that were paid for those companies. We also compile what we call the MarktoMarket indices. And this is sort of our attempt to do for the private markets what FTSE does for the public markets, which is to show the trend in how valuations are trending in the private markets. Now, this is what we call our all-cap index, and we publish this on a quarterly basis. And we have recently published our third quarter 2024 all-cap index. Now, I typically focus on the median numbers. So the median numbers are the hollow circles. And this is looking at the last 5 quarters. Now, if you were to go back before this, our all-cap index would typically trade at sort of 7.5 to 8 times EBITDA. So that's the enterprise value to EBITDA multiple. That's for all transactions that we collect under £250 million. So we broadly define that, and everybody has different definitions of what's small cap or what's SME or what's lower mid-market or what's mid-market. We broadly define that as kind of encompassing the SME market, the lower mid-market, and the mid-market, which is what our customers are broadly interested. Obviously, that's a very broad church. So you have tiny transactions in there for a few £100,000, and you have transactions in there for just under £250 million. But if you and you obviously have transactions in different sectors in there as well. However, what we think this acts as is a good guide to how the market is trending in general. And if you agree with that, then the market is actually starting to trend quite positively from the lows of 2 or 3 quarters ago. So what we've seen here is a bit of a correlation between interest rates. If you look at when interest rates started rising in 2022, and you were to map that against market multiples, there's a correlation there between increasing interest rates and falling multiples. And I think that perhaps now the interest rate cycle has turned, we're starting to see multiples expand again. So the median EV/EBITDA multiple in the third quarter of 2024 was 7 times, and that's up from 6.7 times in the second quarter of the year. If you roll back to the like-for-like quarter in 2023, it was 6.1 times. So that's quite a positive trend there. The other thing that we do that I think is worth flagging here is, and this is data actually from the half year, but what I'm trying to show here is just how we've seen multiples move, or rather we've seen multiple discounts on companies for size. So I think what's quite interesting to our customers when they're analyzing the valuation of a business, a portfolio company or a client, is not just, can I find multiples in sectors that are similar to my client's business, but also can I find similarly sized companies? Because what this chart is showing is the clear correlation between the size of a business and the multiple that will be paid for it. So if you take a median multiple, which was our second half multiple of 6 times EBITDA, what we then do is we split that collective of deals into size indices, and we call those indices the nano cap, the micro cap, small cap, mid cap, and large cap. And what we're interested in here is, what difference does size make to the multiple? And size makes a very, very clear difference. So the nano cap index is companies that were sold for under £2.5 million. So 0 to £2.5 million companies. So that's our smallest index. Now, a typical company, so the median EBITDA multiple there is 4 times. And the devil's in the detail, of course, is some of that contingent deferred. We include contingent and deferred consistently when we look at this. Now, if you go up to the next index, which is the microcap index, multiples expand to 5.4 times. So microcap is 2.5 to 10 times, 2.5 million to 10 million pounds. And then we have small cap, which we define as 10 to 50 million pound deals. And then mid cap is 50 to 250 million pound deals. And you can just see how that multiple grows as you move into the different indices. Large cap is a pretty small sample because there isn't a huge volume of deals that happen above 250 million pounds. But this is something that we see playing out a lot in private equity at the moment, which is influencing multiples. And it's this idea that you acquire a platform business, perhaps in the small cap or mid cap arena. So something that's either between 10 and 50 million pounds or 50 to 250 million pounds. And then you use that platform that you've just acquired in the private equity fund. You use that platform to acquire a number of businesses in the nano cap and micro cap arena, because you can buy those businesses for lower multiples and bolt them into the platform company, the mothership, and the overall multiple of the acquired company effectively rises up into the multiple of the platform. So it's a very, very popular strategy at the moment. Now, of course, what happens when the strategy is playing out in popular sectors, you can see the multiples of small companies start to expand because of the demand for those businesses. So, accountancy is probably a good example of that at the moment, and we're seeing evidence of multiple expansion there and hearing anecdotal evidence that a lot of money chasing similar assets in that sector. So that's just how we're seeing at the moment size influencing multiples on businesses. So that's the M&A multiples. What about fundraising? Well, we look at this slightly differently, and a lot of the fundraising activity that we observe and that we collect is into companies that have probably no profits, and that's why they're raising equity capital, because they need to grow into their cost base. They may have some revenues, but the revenues might be relatively embryonic. So with a lot of earlier stage fundraisings, the multiples aren't really particularly relevant. So how do we judge how the market is trending? And our answer to that, other people may disagree with this, but our answer to that is we track pre-money valuations across a very large sample of companies. So what we do, again, a bit like our M&A indices, we create fundraising indices, and we label those pre-seed, seed, Series A, and Series B+. The pre-seed indices are company fundraisings under £1 million. The seed fundraisings are £1 to £3 million, Series A 3 to 10, Series B 10+. And we stop there because the volumes get very thin. And you can see that on this chart here. So again, the hollow lollipops that you're looking at here are the deal volumes for the third quarter of 2023. So there were 288 seed fundraisers that we collected in the third quarter of this year. But some data, as I alluded to earlier, some data comes in late. So we expect that to grow to about 340. Seed fundraisings, 132, we expect that to be 160. Series A, we expect to get about 100, and then Series B around about 40. In terms of capital raised, the chart is the complete opposite. So in terms of the volumes of fundraisings, it perhaps is expected that the smaller the category, the more fundraisings occur. But when it comes to the gross capital raised in each of those categories, actually it's the Series B rounds, whilst we only see 40 or 50 of them. Those are the rounds where there are the very, very big check sizes. So it's anything above 10 million, but it's not unusual to see 50, 60, 70 million pound fundraisings in that sample there. So of the total capital raised over the period, we think about nearly £1 billion of that total capital. So over 50% of the total capital will probably be in that Series B plus category, even though the volume of deals there is very small. So onto the valuation. That's a bit of context there. How are valuations trending in each of these sectors? So this is looking at quarter on quarter. So this is looking at like for like quarters. So what we're looking at here, the light blue lollipop is the pre-money valuation, the median pre-money valuation in pre-seed in the third quarter of 2024 versus the third quarter of 2023. And actually, it hasn't moved much. It's moved from 3.5 to 3.6 million. So a small movement there over the 12-month period, but not a lot. So if you are raising between 250,000 and £1 million into a startup company, the median valuation in that market is £3.6 million. With seed, actually, we've seen quite a big, what's interesting there is we've seen quite a big movement there. So the median multiple there moved from 7.5 million to 9.2 million. Now, I would always caution that unlike a stock market index where the constituents are going to be broadly the same period on period, with our indices, the constituents are going to be completely different. And what that means is the aggregate quality of companies within that seed sample could be higher. That could be why the valuations are higher. But as I say, the sample size are pretty big, and we're seeing really quite a positive trend there. Series A, so this is the 3 to 10 million fundraisers. Again, year on year, a positive trend. So 17.2 million was the median pre-money valuation of a Series A fundraise using our definition in the third quarter of 23, and that was 20.9 in Q3 24. And then for Series B, I'm always a bit cautious about this just because of the sample sizes. So that again is showing a positive increase, but sample sizes are quite small. So I would take that more on a case-by-case basis. What's quite interesting, I think, is that multiples become more relevant the higher up the food chain you go with equity fundraisers. So once you get to Series B, most companies will have some meaningful revenues, and revenue multiples will start to come into the conversation. But again, I think there is this correlation here between interest rates, cheap money versus expensive money. We, and a bit of upward pressure on valuations in this market as interest rate expectations have tempered. Okay, so just some sort of live trends that we're seeing in the market at the moment. So I think the first one to mention is the impact of, I think Peter will talk more about the budget, but the impact of national insurance changes on valuations. So I think that's more on if you think about the valuation of a business in very simple terms, it's the profit multiplied by a multiple. Clearly, some companies' profits, and this is going to be particularly acute in some sectors, some companies' profits are going to be hit by that national insurance change, and that will therefore, all other things being equal, that's going to have an impact on the valuation. There's obviously the impact of capital gains tax on the valuation. So what's been quite interesting for me is hearing stories about owners passing on that extra capital gains tax bill to the buyer. I guess buyers will have completely different views about whether that's acceptable or not. I think there's also a question here about if I'm a business owner and I'm looking at the net proceeds from a sale, if I have a number in mind, that number, I need to get a higher gross price to get that number now because capital gains tax has gone up, albeit not by as much as many of us feared. Then I think that speaks to the supply side as well. If I'm not getting the net proceeds that I want to get, do I just keep running my business? Do I put it on the market? So far, we're not really seeing that. So it looks like November will be a pretty strong month for, or a normal month for M&A. So not seeing that so far. Risk-off attitude, I think, is something we've been talking about for a long time now. The sort of global sort of geopolitical things, I think, have been holding a lot of businesses back in terms of making investment decisions. It still feels quite risk off. Against that, we have a buyer universe that seems to be growing all the time. We collect information on buyers in the market, and we've seen new types of buyers emerge for businesses. So whether that's employee ownership trusts or search funds, which is probably people used to call MBI teams, private equity buy and build vehicles. Lots of new buyers emerging onto the market. That's certainly giving plenty of supply in the market when it comes to capital looking for deals. And that is all I have to say. So thank you very much, Richard.
Doug, thank you very much indeed. That was a fascinating summary, and it shows you how important it is to monitor trends in the market. And certainly, by the time these transactions take place, obviously a lot of work's been done in the background beforehand, which could be quite time consuming. And from our point of view in London, certainly we've seen an awful lot of inquiries in the last 6 months, which I would define as pencil sharpening. People either looking to value their business, to look at the value of another business they might wish to acquire, or looking at fundraising opportunities and thinking, what is the optimal way of doing it? So, Doug, that's very, very helpful. Thank you very much. So now I'd like to move over to our second guest, Peter Black. So we're now moving from Edinburgh to Manchester. And Peter has extensive experience in deal making. And I'm really looking forward to hearing what you've basically got to say, but maybe just for people who don't know you, maybe you could say a few words about your background, and then we're going to talk about the post-budget and pre-budget attitudes in the market, and then we're going to move over to more general valuation trends and things that you're observing from the north of England. So thank you very much indeed.
Okay, brilliant. Yeah, thank you, Richard. Thank you for inviting me onto this, and thank you, Doug, for the data and insights. As has already been mentioned, we're a long-time user of MarktoMarket and use that data in a lot of the work that we do. So we're used to seeing that data. Yeah. So I'm Peter Black. I'm CEO of the Snowball group of companies. So we're based up in Cheshire near Manchester in the northwest of England, but we have clients nationwide. So we help SMEs with two things. One is funding, and the other is their corporate finance needs. So we help businesses with their sort of a one-stop funding requirement. So we take them from funding strategy, business plans, financial modelling, all the way through to sourcing them debt or equity, or in many cases a combination of both, for all manner of requirements. And we have a network of over 600 debt and equity funders that we work with. We also originate, structure and lead corporate finance deals, which has been a very busy year for that, and a very busy October, and arguably November and December. So we look at acquisition finance, management buyouts, which again have been a very strong sort of area this year, sale of business, including company valuations, and all of that starts very much with sort of sitting down with clients and looking at their strategic options. So that's where it all begins with them.
So I think we've obviously had a budget recently, but before the budget, there was a certain amount of pre-budget speculation and I would say panic, if you like, and people deciding on both sides of, the buyers and the sellers, what they should do. So do you think a lot of the pre-budget activity was basically based upon a fear, or do you think a lot of people were assessing what that fear might be and then actually decided to do nothing in the end and just hope for the best in the budget? And that obviously impacts transaction volumes and valuations. So I'd be very interested to hear about that. And then maybe I'll ask the second question as part of the first question. So do you think sentiment has changed since the budget in that regard?
Yeah, no, I mean, as you say, the rumour mill was going sort of full pelt in the weeks leading up to the budget. So suddenly the activity levels went sort of through the roof, and lots of deals completing very quickly, sort of by budget day or on budget day, or very close to the midnight sort of deadline. Really to try and beat what everyone thought might be coming. And in the end, as Doug mentioned, it probably wasn't as bad as we thought it might be, but there were still changes that happened on the day, and there were obviously changes due to happen. I think the two sides of that is, I think selling a business just for the tax benefits can often be quite a sort of a risky thing to do. I think there should be, the aim should be to try and make the decision by sort of strategic long-term considerations, rather than reacting to some sort of short-term tax change. Because my worry was that unless you were already in an advanced sort of sale position leading up to the budget, if you suddenly rush the transaction, there could be things that were missed. There could be buyers saying, well, actually, we'll offer you a bit less because we know you've got this deadline coming up, and you either sort of sort of a bit like Russian roulette. You either go with the deal with a bit less money, or you wait and see what happens. So and the other worry was that, were there things agreed or not agreed in sale and purchase agreements that could come back to haunt people a bit in the future, because they weren't necessarily sort of reviewed or analysed or negotiated, because it did seem, or every single law firm that we deal with in the corporate finance, they seem to be so busy doing multiple deals, and could there be things that sort of fallen through the cracks? So I was a little concerned that unless you were deep into a deal already, then could things be missed. I think the deals that we were working on, I don't think there were any that suddenly started and finished by that date. The ones we were working on completed. Some completed a bit quicker, because obviously there was that date in mind. But I think there's the longer term view, and the other things you can do for your business to increase that multiple, increase the profitability to affect the multiple, is probably a better use often than some tax change, which, well, as we say, you can't control, because we now know the tax changes as they were in the budget, but they could change again. So we've had, just I suppose to reiterate in terms of the numbers, we had, well, it used to be entrepreneurs relief, now it was renamed business asset disposal relief. So that was 10% up to £1 million of lifetime gains, and 20% above that for higher taxpayers. From the date of the budget, the 10% stayed, but the remainder then was taxed at 24%. So quite an increase. So those that did complete the deals before the budget day, obviously will be pleased with that result. Then the business asset disposal relief increases to 14% in April 25, and then 18% in 26. So we now know they're the future step. So it gives businesses and advisors more time to plan to do things, rather than as that mad rush. I mean, Doug mentioned about the number of deals that happened in October. I was at it was a presentation that Doug was giving in Manchester around about that time, and it was estimated, and it was 350, it's probably a bit higher than that now, extra deals just in the month, which is a lot of deals, being done all at the same time, to hit that deadline of something that may or may not happen. So I think there was a worry for me that there's, things could be missed, or so trying to do a sort of longer term strategy probably would be better in the long term for the businesses where that's possible.
Okay, so thank you for that. So if we sort of look forward to 2025, which is what a lot of people are already doing, and looking at broader valuation trends, based on what happened with the budget and national insurance, etc., there's a number of people reviewing their staffing needs and all sorts of elements like that. And there's also been the rapid adoption of AI coming in as well, which can completely change your business model, or the way you plan for your expansion, and that would be a classic for a company like ours. What do you think the climate in the Northwest is in terms of 2025? Because do you think it's positive and stable, or do you think it's positive but it's still on an upward trend? Because we've now got various things out of the way, like the American election and the budget, etc. And people can say, well, interest rates, they're certainly not going up. They're probably going, if they were to come down, that might offset an increase in, let's say, staffing costs. I'm just making that up as a suggestion. But you've got to have good sentiment on both sides, haven't you? From the companies have got to be able to think they can get to their target, and the investors have got to be able to believe that, yes, it's an investment opportunity. And one of the things that we have come across lately is a lot of questions asked by potential investors about how much money, how much cash does the company have? How long will it last before they do their next round of funding? Whereas in a bull market, you assume that in 18 months to 2 years, of course, you're going to need more money because you're so successful. So have you got any insights on that sort of specific point as well?
Yeah, no, absolutely. I mean, in terms of the Northwest market, I would say it's Manchester and the wider Northwest market. It's a buoyant market. There's lots of activity going on. I think as a market, it's well, certainly in October, it's probably never been busier for a very long time. But that does seem to it didn't stop at the end of October. It's continued. Everybody you speak to in the market, whether that's the funders, the investors, the banks, customers, professionals, everyone is busier with inquiries. Now, those inquiries, some will lead somewhere, some won't. Some are sort of looking at, there's all these things up in the air. How does it affect me? How does it affect my business? What does it look like going forward? And you made some good points, which Doug also picked up on, in terms of change, like the national insurance has can have a potential quite a big impact on businesses. I mean, we've been out to some clients where the increased bill for the national insurance is some are hundreds of thousands of pounds, some are in the millions. They're big numbers that you've got to sort of take into account, and you've got to work out what's the compensating element for that. So will people put up their prices? Will they reduce the number of staff? A bit of everything. So it's how do they offset those increases, or do they take it on the chin? In which case it reduces their valuation, and then does that that could impact the valuation of the business. So that's something aside from the tax relief elements that's obviously quite sort of key at the moment. Interest rates, Doug mentioned that, as you say, I think we've certainly peaked in terms of interest rates. They're coming down, probably not as fast as we all were originally expecting or even hoping. I think because of the budget, that sort of pushed it back a bit, and they'll probably come down a bit slower rather than the elements we were expecting. But that still helps. It helps deals. It helps the debt capability of buyers. It helps the valuation. So it's another part of helping the market sort of going forward. AI, we've seen quite a bit of movement on both sides. So you've got AI for software businesses, for semiconductor manufacturing. It's pushing their valuations up because of AI helps their businesses, and it's making an increased market for them. But on the other side, you've got businesses where the use of AI by their competitors is going to be a real sort of competitive feature against what they do. And it's some people having to look at their business models and change how they do things, or adopt AI themselves in more of a way. So it's AI is still it's still very much early days, I think, in the use of AI. So I think we've got a lot more to come on that, but it will affect some businesses a lot more than others. And as you say, the geopolitical elements, you've got the wars going on, you've got US and China trade, you've got obviously Trump coming in early next year, although he's already busy. So there's all these things going on. And the other side of that, I suppose, is economic growth or lack of, and how that all plays. So there's a big mix of things in there to consider, even aside from the sort of the tax elements that will sort of unfold themselves in the months to come into 2025. So activity-wise, I think it's very busy in terms of clients wanting to see what are the options. Is it a sale now? Is it improve the business and make those changes to increase that profitability? And therefore, they can't do much about the multiple. The multiple is in many respects driven by the market, so you can't impact that, but you can impact your numbers, your business, and those changes by the multiple are likely to bring you a higher benefit in yield than worrying about sort of short-term tax elements.
Okay, well, look, Peter, thank you very much for your valuable insights. There's quite a lot more we can talk about, but unfortunately we've run out of time. So also, Doug, thank you very much for your time this morning. As I said, this is the second in a number of these events that we're going to be putting on in 2025 on various topics surrounding private company valuations and the whole community and how it interacts. So we'll be in touch shortly about the next episode. If in the meantime you have any questions, comments, or observations about this particular broadcast, we'd be very happy to hear that, because that helps us fine-tune the future events that we organise. So thank you very much indeed, and hopefully see all of you on the next meeting. Goodbye.